Okay, and welcome back, students who are taking financial accounting. And in this series of videos, we are working on the theory for Chapter 10, which is corporations, paid-in capital, and retained earnings. And this will be the last video in this series of theory. And as always, at the end of each chapter, we deal with the focus on decision making, which is, our analysis of our ratios for analysis for those particular concepts in that chapter. And then this one here, because we're talking about the equity section of the balance sheet, we really only have right now that's important is our return on equity, just this one ratio. And again, if you've been following along, you've heard me always say, if you're not, if you need another look at these ratios and you had math for business and finance or math applications, those ratios were covered in that particular subject. So this is like the second time you're taking a look at it. If you hadn't had those subjects, then what you can do is under the business group here on the student community in the math for business / application section, there is it's one of the last two chapters where they cover all the ratios in one particular chapter. So you could go back and watch those theory videos and work on some of those homework problems that were in the math for business or business and finance or math application subject to if you need additional look at it. But again, these things are, this is already like the second time that you're seeing this, and you should be getting it after this. Yes, it'll be covered again in future subjects like in financial management, managerial accounting, and by then that's gimme work. I mean, if you get a test question with that on, you should get it right. But I'm surprised at how many students still get them wrong. Right? So just because you've seen this before, don't just gloss over it. Right? Because like I said, it surprises me how many students actually still get this wrong in future subjects when they really shouldn't. All right. So return on equity is basically your net income over your average stock. Oh boy. Over your stockholders. I know I didn't spell that right. Equity. Right. Remember what we're talking about here is return on your equity, the return on your investment. Right. Well, if I have stockholders' equity, that is my investment in the business. When I generate income, all right, that is the return that I'm getting on that investment in the business. And that's why we're dividing our net income by our stockholders' equity. But notice it says average, okay? Average being that you have to look at it from the perspective of the stockholders' equity doesn't necessarily stay the same, okay, throughout the entire accounting period. I mean, oftentimes it does, okay? You have a beginning stockholders' equity, all right? And I'm just going to make up a number. Let's say it's 500,000, okay? And nothing happens to that account. There's no change in the equity accounts other than what would happen with retained earnings, okay? And that means you would close it out. Well, I'll get into that in just a second. But if nothing happens and your ending stockholders' equity stayed the same, all right, meaning you really didn't have any, you didn't have a profit or loss, and you didn't have any effects on stock or things like that, then your average stockholders' equity is taking your beginning plus your ending, right? And then you divide it by 2. Well, 500,000 plus 500,000 is a million. Divided by 2 is still 500,000, right? Well, you saw no change between the two, so your stockholders' equity is 500,000. However, that doesn't, only, it all depends upon when you're doing it. when you're doing your analysis. And to be honest with you, if you started out with beginning of 500,000, all right, even though you'd have no changes um, in your stock, all right, throughout the entire accounting period, by the time you get to the ending the end of the accounting period, um, that ending is generally not going to be the same. And the reason why is because you have a retained earnings account, right? And in the retained earnings account, your net income, right, your net profit or your loss, right, gets closed out to that retained earnings, which does change that beginning figure. So let's just say we had $50,000 in profit, which would end up in retained earnings. So my ending figure would end up being 550,000, right? So that's why you have to take an average of your stockholders' equity, because even though the majority of these accounts don't change during an accounting period, your retained earnings generally does, just because you're closing out your income to the retained earnings, whether you have a profit or loss. So the average is, of course, beginning plus ending. So it's 500,000 plus 550, all right? And you divide that by 2, all right? So that's 1,050,000 divided by 2, or 525,000 would be your average stockholders' equity, right? And you would divide that into your net income. Well, we determined, from this quick example, I said, oh, our net income was 50,000. So I have 50,000 divided by the 525, and that would give me 50,000 divided by 525,000, and that would give me a 0.95, or which is equal to 9.5% return on my equity, on my investment. Okay. From the textbook, I'll just go over that real quick. They're saying that their net income was 136,000, right? And then they calculated the average stockholders' equity, meaning they started out with 825,000 as their beginning stockholders' equity. And let me just do a quick math here. 825 plus 136. Okay, 961. All right, so they actually used 943,000 as the ending. Now, the reason why I paused, I punched on the calculator, and this is what I did while off screen. Okay, I had said their beginning was 825,000, right? And they had a profit of 136,000. Okay, which means they had 961,000. All right, but notice their ending is only 943. Right. Well, the difference between the 961 and the 943 means that there was some other change that occurred, and that change could have been a payment of dividends, right? If they had paid out dividends, they would have paid out $18,000 in dividends, right? Notice what I did. Okay, I took my beginning, and now this is something you're not getting in the book here, but just follow along here. And this is, if you understand the overall concept, you can work through all of this. I mean, you're not seeing this in the chapter. I could have just simply said, okay, I have 825 as the beginning, 943,000 as the ending. I divide that by 2, and that gives me 884,000. So I have 136,000 divided by 884,000. And that gives me a return on investment of 15.38%. And I could have said done, finished, all right, end of video, right? But what I'm doing here is if I understand the structure of my stockholders' equity, I have a beginning, right, which that beginning included things, my common stock, preferred stock, all right, treasury stock, retained earnings, okay, when I take into consideration all of those, right, and I add them all up, I had a beginning of 825,000 as my equity. Now, that's my beginning, 825,000. But, and now I also know that I have my ending, which is common stock, preferred stock, treasury stock, retained earnings, right? And that all gives me an ending of 943,000, right? So that's my end. Well, if I take my beginning, which takes into consideration any of these things in my equity section, and that's 825,000, and I know that my net income for the period is 136,000, right? Well, that net income affects this retained earnings account, right? So with everything, if this was 825,000 and all I did was closed out my net income to my retained earnings, my 825 plus my 136 should have given me 961,000, right? That's what I did here, 961,000. But my ending, they're telling me my ending is 943, right? My ending is 943. Well, why isn't it 961, right? You know, if I had 825 and I added in the net income, I end up with 961,000. But it's telling me my ending is 943. Well, the difference between the two is 18,000. Why do I have a difference between the, a difference of 18,000 between what I've calculated and what they're actually telling me the ending is? Well, most likely, right, assuming that, we didn't retire any stock, or we didn't have some kind of change in that, as far as our stock position is concerned, that means we ended up having to pay out dividends of 18,000, which would have affected our retained earnings, okay, and that would have allowed us to end up with that 943,000 as our ending stockholders' equity. Right? So you see how, if you understand the underlying concepts, you can work through the information in your head in order to build the entire picture. All right, you don't take things for rote or just given and just say, okay, yeah, the book says I have 825 and I have 943, so that's 136,000 divided by 884,000, and I get 15.38%. Yeah, that's how you do that, right? That's how you do that calculation, and you just took the numbers for granted, all right? But when you're giving a problem, you're not going to be told, you or when you're in the workplace, it's not going, you're going to know that you had 825,000. Actually, let me do that in green. You're going to know that you have 825,000 as beginning equity because that's your ending equity from the previous period, right? And during the course of the period, you get to, you're going to make your sales and you have your expenses, and at the end, you're going to have your net income of 136,000, right? But what if the problem says you had a beginning, you had an ending from the previous period of 825, you had, say, 374,000 in sales. Let me do some quick math here. That's 8, 2. You had 128,000 in expenses, and you also had 18,000 in dividends paid out. What is your return on equity, right? Well, if you're given the information in this fashion, you're going to have to go through everything that I just went through to be able to figure out your return on equity. Okay, so it's no longer as simple as what you see in the book. And again, that's, you need to understand the whole underlying concept and use what's being applied. And I know that sounds like me harping here, but I wanted to point it out because when I looked at it, what you saw me calculate is what I saw in my mind, right? I didn't just sit here and took the 943,000 at face value, okay? In my mind, you saw me take the 825 plus the 136 and came out with the 961. And so why is that different than the 943? Sure, that's the actual number, but why is it? Why is that? Well, the why is because 18,000 is dividends, right? And so now that justifies that number. So when I'm actually doing a problem or I am in a situation, I further understand the entire concept and all the parts that fit together for a simple calculation like this. This is simple, when you're just given the numbers exactly as you need them, and just plug in the numbers and work the formula. But realize that's not how the information comes in the workplace, and it's not how the information comes in your problems or your test problems. So without harping, again, it's about understanding the concepts and then applying that information. It's not about cookie cutter, looking looking it up in the textbook and just replacing numbers. It doesn't work like that. All right, so with that said, I'm done with the theory for chapter 10. Sorry about that, but I'm getting on my high horse about that because, I just hear too many students, who just want the quick and easy way out, and this is not a subject that is conducive to that. So that's the end of the theory. Next, we'll work on the exercises in the next series of videos, and hopefully you'll work those out along, and see the underlying, the application aspect of those underlying principles. All right, so I'll see you then.